Today I have with me Jerry, our amazing mortgage specialist, here to talk to us about the interest rate hikes. Recently, I don't know if you guys have heard, there's a 0.75 hike from the Bank of Canada yesterday that was announced. So I don't know what that means to me. It just means that there's just more numbers going up. So I asked an expert.
So in today's Zoom call, I'm most likely going to talk about three things with you. All right. So the first part is I want to talk about what is the stress test. Okay. And the second part is I'm going to talk about how changes in variable and fixed rates are going to directly impact this stress test. And then lastly, I'm going to talk about and illustrate to you guys a real world example of how the stress test will impact and affect your borrower's purchasing power. What is the stress test? So the stress test is basically a test to determine how much you can afford, your financial capacity on how to handle rising mortgage payments and rising costs in the event the rate environment is highly volatile and is rising as we've seen today, right? The stress test requires, federally regulated banks to check that borrowers can still borrow and make their mortgage payments based on a rate higher than what you are actually paying for. The general rule of thumb is when you walk into a bank and apply for a mortgage, you're actually stress test based on two things, okay? The first part is your contract rate, the rate that your bank will basically give you, plus 2%, or the Bank of Canada qualifying rate, which is 5.25%. The caveat to this is whichever is higher will become the stress test. This is kind of going to lead into the second part, which is, how changes in variable and fixed rates are going to directly impact the stress test. So how does this change in variable and fixed rates affect the stress test? Now, recall in the first part of the discussion, I told you that we're basically being stress tested on two things, okay? One is your contract rate plus 2%, or the Bank of Canada qualifying rate of 5.25%, whichever is higher, okay? So let's say, back in May or June, fixed rates were starting to increase very, very aggressively in comparison to your variable rates, right? We started to see a gap grow further and further between the variable and the fixed, right? I think variable was still in the 2%, whereas fixed were maybe in the mid 4%, okay? Now, the reason that most people gravitated towards choosing a variable rate was the benchmark, the stress test, basically, right? So take, for example, a variable rate of 2.5%, okay? Remember the two rules of the stress test. So 2.5% plus 2% equals 4.5%, right? That is less than the Bank of Canada qualifying rate of 5.25%. Therefore, your clients or borrowers will be still stress test at 5.25%. That time, clients were qualifying on 5.25%, right? Whereas if your clients were leaning more towards a 5-year fixed rate, for example, at 4.5%, all of a sudden 4.5% plus 2% is 6.5%. It's actually higher than the Bank of Canada qualifying rate of 5.25%, which means your new stress test based on the 5-year fix will be 6.5%. The higher the stress test rate is, the lower it's, or the more it's going to impact your purchasing power, your buying power, which in effect is going to reduce the amount of mortgage you qualify for. Hence, why so many people were gravitating towards a variable rate at the time, even if they didn't like a variable, right? People who normally pick fixed were going towards variable because they could qualify 30, 40, 50, 60,000 additional mortgage compared to a fixed, right? And it makes sense, right? It's logical that people, gravitated towards the variable because the stress test was just lower, right? Now, fast forward today, when the Bank of Canada is starting to aggressively, announce rate hikes, March, April, June, and then July 13th was a big one, was the 1% one that really did it in for a lot of people, right? So now what we're seeing is the gap for the variable rate and fixed rate, the 5-year comparable, starting to close further and further, right? But even though the variable rates are still cheaper than the fixed rates, people are still trying to choose the variable rate because of the amount of mortgage that they can qualify for, right? Mm-hmm. So at this point, it really has nothing to do with, whether or not I prefer variable or fixed. It's what product will allow me to qualify for the most. And right now, it's the variable, right? So now maybe we'll go to the third part and we're going to illustrate how the stress test is going to impact your borrower's affordability. How does all of this affect, a borrower when they are applying for a mortgage loan? Okay, so the general rule of thumb, is borrowers must qualify on 1 contract rate plus 2%, or the Bank of Canada qualifying rate of 5.25%, whichever is higher. Okay, so that's just general rule of thumb. Now, I'm going to illustrate to you how in a rising interest rate environment can directly impact your purchasing power, right? And why it's important to, always consult a mortgage professional and to consistently update your pre-approvals based on a highly volatile rate environment that we're in right now, okay? So let's just take for an example number one. So let's just say you had a client, Joanne, that wanted to purchase a condo for less than 20% down payment. Okay, let's assume that your client was purchasing an insured mortgage, which means is less than 20% down payment. Okay, let's assume that the household gross income is $150,000 per year for 2 people, or maybe even 1, who knows, right? And let's say the down payment was $80,000. Sorry, I don't know why I wrote per year, but let's say the down payment was $80,000 per down payment, and let's assume that the condo property had $2,500 per year property taxes, $600 per condo fee, okay, per month for the condo fee, right? This could be anywhere. It could be in downtown Toronto. It could be, in older buildings with higher condo fees. But I'm just putting these numbers to basically just illustrate the numbers, okay? So assuming that your clients were pre-approved for a mortgage that had a 3.8% variable, okay? 3.8% variable, 5-year variable at 25-year amortization. Okay, you see it? Mm-hmm. Now, the amount of mortgage that they can actually qualify for is going to be $650,000. That amounts to a payment of about $3,452 per month in monthly mortgage payments. Okay, so now how does the rise in interest rates affect the stress test? If you look at the variable rate of 3.8%, what would be the stress test if your contract rate was 3.8%, Joanne? I'm going to test you on that.
So 5.8%.
Perfect. Yeah. Is that higher than the Bank of Canada qualifying rate of 5.25%? 5.25. It is, right? So when we're doing a stress test, whenever mortgage agents like us and bank specialists from banks try to qualify you for a loan, we have to use the new stress test now. Okay, so whatever the contract rate is, we're going to add 2% to that, and then we're going to determine what the new stress test is. Okay, so it's going to be 5.8%. Now, yesterday, on September 7th, the Bank of Canada introduced another rate hike of 0.75%. This 0.75% is going to directly target the prime rate of banks, and obviously, in effect, it's going to directly affect your contract variable rate. Okay, So the 3.8% rate all of a sudden becomes 4.55%. Now, what we're going to see is your purchasing power, okay, based on the new qualifying rate. And by the way, Joanne, what would be the new stress test rate?
So based on this, if I'm adding 2% to the contract rate, then the new stress test is 6.55.
Perfect. Exactly. Okay. So the new stress test is going to be 6.55%. Okay. Much higher than the Bank of Canada, benchmark rate of 5.25%. Right. So this is as a direct result of this, because it's a higher stress test. Remember, the higher the stress test, the more it's going to attack your affordability, right? It's going to reduce your purchasing power, and therefore your mortgage qualification is going to reduce. So for the same amount of income, same amount of down payment, same property type, assuming all variables are the exact same, but the rates are different and the stress test is different, now your mortgage qualification reduces to $610,000 as opposed to $650,000. So that's a $40,000 drop in your client's purchasing power, right? So if we take a look at the first example, Joanne, so $650,000 plus $80,000 down payment, that's a purchase price of $730.
Yep.
Right?
Which is a pretty good price to buy a condo downtown if people are looking.
Yeah, it's pretty. It's awesome, right? In other places, you can buy a 2-bedroom, right? Possibly, maybe. Once the stress test, comes into play, and the Bank of Canada announces these rate hikes, all of a sudden, your clients or your borrowers are directly impacted negatively by a rising rate environment. So now you went from 650 down to 610,000. If you add the 80,000 down payment on 610, the maximum that you guys get afford is only 690 now. If you look at the first scenario, Joanne, the interest rate for 3.8% variable based on a 650,000 mortgage, right? Your payment is going to be roughly like 3,452. Obviously, it's going to be a little bit higher because I haven't factored in the insurance. So I'm just simplifying things, okay, for now. So I didn't include the insurance on the 650,000, but notice that when the interest rates increase, your mortgage eligibility decrease, right? But your payment is still like this relatively the same, a little bit higher, only because the interest rates increase. So as the rates increase in a highly volatile rate environment, your monthly payment is going to increase, but your mortgage qualification is going to decrease. You see how the stress test and rising rates are going to significantly impact your purchasing power. So now I'm going to use another example of how this is going to be affected by using 20% down payment. So let's just assume that your clients have 20% down payment, okay? And let's just see how the numbers look. So with a 20% down payment, assuming the variables are the same, right? 150,000 yearly gross income, and let's say the down payment was 20%. I don't know. Let's say it was 180,000. Okay, 180,000 for the down payment. Let's say it's a freehold townhouse with a property tax of 3,500 per year. Okay, that sounds pretty reasonable, right, Joanne? Just break down the numbers for the down payment. Let's assume the down payment wasn't really a factor, but let's assume they had 20% down payment. Okay, so I'm going to use TD's advertised contract rate. So if we use a 4.45% contract rate, okay, 30-year amortization, okay, 5-year variable. Again, this is a variable because variable is still cheaper than a fixed rate, which means you can qualify for additional mortgage. We want to be able to maximize as much purchasing power as you can. This is why I'm using the variable as an example. So if your clients chose a 4.45% variable at 30-year amortization, they can qualify for $720,000 for the mortgage. Okay, that payment amounts to be $3,609 per month. Okay, now if we were to take the September rate hike into consideration, the September 7th 0.75 rate hike, that 4.45 becomes 5.2%. Okay, for the same variable product, 30-year amortization. Now their mortgage reduces down to $670,000 with a monthly payment of $3,656 per month. Okay, so this is how the stress test is going to impact people with, let's say, 20% down payment. Okay, assuming that they have a gross salary of 150 per year, the down payment is 180,000. So if you add 180,000 down payment to 720,000, that would be a purchase price of 900,000. You can get a townhouse for 900,000, right?
Okay.
Yeah. Okay. Fair enough.
Yeah.
And 900,000, 20% down payment is 180,000. So this is why I use 180,000 as a down payment. Okay. But with the September 7th rate hike of 0.75%, that 4.45% 5-year variable becomes 5.2%. Okay. What would be the benchmark stress test for this, Joanne?
7.2%. Really?
Exactly. 7.2%. Okay, their mortgage reduces to 670,000, all the way from 720,000. That's a 50,000 drop, right? So if you had the same amount of down payment of 180,000 plus the 670,000 mortgage, now your purchase price is going to be reduced to 850 now, right? Again, that's going to create a lot of stress for your clients, going to create a lot of stress for you. You might have to reevaluate the geographic areas that you guys are focused on, right? You might even have to sacrifice a freehold townhouse for maybe someone with a condo, like a condo townhouse. Again, it's really going to alter your client's expectations, and it's going to really alter their their financing, so to speak, right? So, and this is how basically the stress test is going to directly affect your clients. Now, apparently, the next 2 meetings for the Bank of Canada is going to be on October 26th and December 7th. And I'm hearing that they might do smaller increases of about 0.25% for the rest of these 2 meetings to cap off the 2022 year. Okay, that's rumors, right? And rumors are that in 2023, that the Bank of Canada is going to absolutely stop all interest rate increases and just see where inflation goes in 2023. Because the more rate hikes that we're going to see, the more likely that the Bank of Canada is going to really make our economy suffer. And this might directly or indirectly create a mild recession, which a lot of people are predicting as well too. So we might experience a mild recession going into the first quarter of 2023, or it might even happen right now, maybe in the last quarter of 2022, right? Again, I'm not an economist, I'm not a financial expert, but this is probably most likely the pattern that we are heading towards. Now, some of your clients obviously are concerned or maybe upset or obviously clearly frustrated about the amount of mortgage or purchasing power that's been reduced, since these rate hikes. However, the caveat to this, or the silver lining to this, is this is going to create, theoretically, it should create downward pressure on listing agents and sellers to lower their price, to adjust for the fluctuations of the reduced purchasing power, right? Just to kind of align themselves with the stress test of the borrowers today, right? So again, you might qualify for less, but at the same time, you might even get something for more of a discount, right? Again, it depends on where the market, is going to go.
Yeah.
Now, the only way to hedge against that is getting a pre-approval. Okay. Yes. When you have a pre-approval, that protects you from rising interest rates, especially for fixed. Now, for variable, that's a little bit different, right? Some banks don't provide pre-approvals for variables, and some lenders, especially for insured mortgages, if you were pre-approved for, let's say, 3.8%, right, rate went to 4.55%, you still have to qualify based on the new 4.55%. You know what I mean? Whereas if you were on a fixed, and let's say you were pre-approved for, 5.2%, even if the fixed rates goes up, you're still going to qualify under the 5.2%. So you're protected on the fixed portion, not on the variable portion.
Awesome. Well, thank you so much for your time. This is basically wrapping up the end of the Zoom meeting. So Jerry, do you want to remind everybody where you're working right now and how they can find you? I'll definitely put your contact up in the post as well. And if you guys have any questions, leave it in the comments, or you can just directly send me a message.
Yeah, so I work with Dominion Lending Centers. That is the parent company that I work under. I'm an independent mortgage agent. You can reach out to me anytime. You can email me, text me, give me a call anytime to inquire about pre-approvals, to see how the stress test is going to impact you and your family, rising interest rates, environments such as this, and what you could do to protect yourself in these highly volatile times, right? So.
Okay, awesome. Thank you so much, Jerry.
Awesome. Thanks, Joanne.